Welcome back to Happy Hour, everyone. Time now for the Diamond District. The higher the risk, the higher the return. Should that be the case when it comes to taxpayer money, though? State and local governments are making risky bets with billions of dollars in pension funds to try to get higher returns, but municipal financial experts say these gambles may turn all of us into losers. How so? Well, let me ask one of those experts. Joseph Fichera is CEO of Saber Partners, and he is my guest today in the Diamond District from San Francisco. Joseph, how so? I mean, if you're not in a pension fund, a state, your local government, teacher, firefighter, pension fund, how does it affect the rest of us if they do poorly in their performance?
Well, those obligations, those promises need to be kept, and they need to be funded somehow. Teacher salaries come from taxpayer monies, and so ultimately, if you don't have the investment returns that you're expecting, you're going to need to supplement that somehow with other revenues in order to keep those promises, or you're going to need to change the promises.
Yeah, that's why we see the stimulus money going to keep teachers employed, keep their benefits, and so forth. You know, there's been a lot of write-ups recently, a lot of people talking about the fact that in corporate America, company pension funds are going more conservative, taking money out of stocks and putting them maybe in bonds, as we don't know really where this economy is going. Yet you see state and local governments doing the opposite. Getting into very risky bets. I mean, some of the stuff that I saw here, commodity futures, junk bonds, foreign stocks, even back into mortgage-backed securities and margin investing. This was from the New York Times talking about that. People who are relying on these retirement funds, if not now, in the future, should they be worried about this?
Absolutely, and because there's two big problems here. First, people really don't have a full understanding of what the problem is in terms of the disclosure of how much liabilities there are going out in the future. The private sector has much better accounting, much better controls, and actually has done some of the changes that are necessary to try to deal with that because they have the discipline of the market to sort of force them to do that.
Right.
For example, GM had major problems. They moved out of equities earlier on trying to help themselves. The public sector has lagged that because it really would like to put off the day of reckoning that it comes. That if we can change some assumptions, if we change some projections, if we try to think that risk premiums are guaranteed rather than knowing that phrase that past performance doesn't guarantee future results.
If we haven't learned
if you had to actually deal with that, you would have a real bigger crisis in state and local finance than you already have.
Let me explain what you mean. It's that pension funds, they have this obligation, and many of them are underfunded. People are due more than the amount that they have in their fund. So what the pension funds do is they have these expected rate of returns. Say, I think most of them are like 8%. Maybe some say, oh, we're going to get 8.5%. A lot of people aren't getting that. Even your savviest investors are not getting 8.5% return in this market. These state and local pension funds haven't changed that because if they do, they're going to be even more underfunded than they already are. So their premise is just flawed, Joseph.
That's right. It's a sort of don't ask, don't tell policy in terms of pension management. People don't really want to ask who really know, because if you do, you're going to be confronted with how are we going to adjust for this? What does it mean for taxes or cutbacks of services or things that need to be restructuring?
Or the
there
cost
is a
of
small
living.
Bankruptcy that's going on. Yeah, or the cost of living increases, the various promises that were made in good times with projections that were thought that would never change.
Right. I want to hit on before, Joseph, we're running out of time.
You need more realistic assumptions.
Right. We're running out of time. I want to hit on something, one of your talking points. You say public pensions are an entitlement program, and it used to be that public employees paid low salaries and rich benefits, but now the non-financial sector, basically the private sector and the public sector, it's almost even, so the public sector jobs cannot offer these luxurious benefits anymore. They can't afford it.
I agree. It is. That's the problem. We have overpromised certain people, and there used to be a trade-off there in the past, but now there's been a levelizing between the corporate and public sectors in terms of basic salaries, and the benefits need to adjust. On the corporate side, there has been a lot of restructuring and adjustment. You need it on the public side, but that's just something that people really don't want to confront and don't want to deal with because of what it means. They're playing gimmicks. When you start hearing about selling assets or strategic funding of pension liabilities, be nervous.
Yeah. Joseph Fichera, thank you very much for joining me in the Diamond District. Again, folks, something all of us have to be worried about because those pension funds, they go belly up. We're going to pay for it one way